right. Good afternoon or morning, depending on where you are dialing in from. But either way, thank you very much for joining us today. I am Dan Pascone. I'm the founder and CEO of Tailored Wealth. And what we do is help business leaders and executives to optimize their financial resources so that they can enjoy life on their own terms. So thanks to any and all clients from Tailored Wealth that have joined us today. And I know that we also have many folks here that'll be joining from our Making Sense of Your Money community. So whether you are a part of our newsletter community, our YouTube channel, or our podcast, we welcome you as well. And if you haven't yet subscribed to our newsletter, I'll drop a link in the chat. It's free. It's a weekly resource filled with actionable financial tips and strategies that are designed specifically for busy professionals. So if that's you, and you're not already a part of our newsletter community, I know many of you are, we'd certainly love to have you. Today's session is a part of our quarterly markets update series. And the goal is to educate our clients and our broader community about what's happening in the economy and the capital markets. And I think it's safe to say there's a lot going on right now. But most importantly, what we want to do is we want to talk about what it means to your investments and your overall financial strategy. So whether you're a Tailored Wealth client or just a part of our extended community, we hope that you leave today with insights and clarity to navigate these turbulent times that we're in with a higher degree of confidence. So a few logistics for today before we get started. So first off, the call is being recorded. We are going to offer a replay for a limited period of time after our call. And then to complement today's insights on navigating market turbulence, we've created a brand new tool that we'll release for the first time today to all of our participants in today's webinar. So make sure you just stay on, and I'll share that at the end of today's call. And then, as always, with any of our programs, we want to make it interactive. So we invite you to submit questions in the chat. So I'm going to get the chat fired up here in a couple of minutes, but we invite you to submit questions as you have them, and we'll pause periodically to answer them, and then certainly answer at the end as well. All right. So I always like to start any of our programs with kind of getting the audience involved and starting with a few quick questions. So the first one is, and we're just going to ask you to answer them. All of our participants are muted, but we're going to ask you to just throw your answers in the chat. So the first one is just a quick yes or no. Have recent headlines around global trade uncertainty made you rethink your investment strategy? So has the recent turmoil and everything that's going on with global trade made you rethink your investment strategy? And then you can just send your responses here. All right, so I'm seeing a few yeses for sure. Thank you. Hey, David, how are you? So seeing a bunch of yeses coming through. Okay, very good, very good. I think that's very, very normal. I think some people are saying somewhat. Some people are saying yes for sure. All right. Second question is, on a scale of 1 to 10, how confident do you feel about your current financial strategy's resilience in today's market turbulence? Your current financial strategy's resilience to the market turbulence that we're facing today. We're getting some 7s, we're getting some 8s. So people are semi-confident, bunch of 7s. 7s is the typical answer I see. I think that's pretty typical. So that makes a lot of sense, and that checks out. All right, last but not least, so our third question. If today's webinar could address one key challenge or concern you have about navigating market uncertainty, what would that be? One key challenge or concern. I would love to hear those. And like I said, I'll let those questions just kind of come in. I'm not going to read them out loud right now because we are going to hit on questions and commentary from the group as we go. And I'm excited to bring on our keynote speaker to do that. So with that, keep those answers coming through, and I'll pulse the group as the webinar progresses. But I'm excited to introduce our guest speaker today. We are excited to bring back Bill Manegio from JP Morgan. Bill, who's joined us in the past, is an executive director and a client advisor with JP Morgan funds in the Northeast. He holds a CFA and a CIMA. And, at Tailored Wealth, we pride ourselves on independence, and we work closely with many outstanding asset management partners. And we specifically choose Bill and JP Morgan for these quarterly market insight webinars because, in my opinion, they are the best in the business at breaking down complex market concepts and the economy in general, and then weaving those into actionable insights for individual investors. All right. And that's what we're hoping to do today. They have a renowned program called the Guide to the Markets. It comes out quarterly, and it takes their extensive research and boils it down into clear, relatable perspectives on how the market dynamics will directly impact you, right? So it's not just about what's going on in the economy. You can get that on CNBC, but I think what you're going to get today is how it can really impact you. So I always enjoy Bill and JP Morgan's commentary, but with the recent market environment we're experiencing, I think their insights are more timely and essential than ever. And these are precisely the questions I think that Bill's going to answer today that we're hearing about on a day-to-day basis. So without further ado, I'm going to turn it over to my good friend, Bill Manegio. Bill, thanks for being with us.
Dan, thank you. Can you see me okay? All right, excellent. Great introduction. I should have written some of that down about what you said about Guide to the Markets. It's spot on. So again, thank you. And Rich, thank you for having me on. There is a lot going on, and I'm just going to go ahead and share my screen. Dan mentioned the Guide to the Markets. So what you're going to see is a subset of those slides as I go through my commentary, just to give a visual to the concepts and data we're going to go through. And I think what I wanted to do today, and normally this quarterly update is relatively simple in the sense that typically I'll do an economic update, what's going on in the economy, what's going on in the markets and the bond market and the Federal Reserve. But given what's happened in the last month, I almost find it more important to just take a huge step back and try to put a little bit of a silver lining on this volatility that is apolitical. It's simply looking at what we believe and what most economists believe is the single largest problem to the generation that is probably on this call and the generation behind us. And that's the United States debt clock. I remember as a kid, I grew up in Connecticut. I remember being in New York City and Manhattan the first time, and we drove by that famous clock. And I don't even know where it is anymore, to be honest. But I remember seeing the numbers. And of course, if you've ever seen it before, those numbers are ticking up really, really, really fast. And the reality is that I guess that was put there to like scare people, but what a terrible data point it is just to understand the amount of debt, because there's other things you need to look at. What I mean by that, and I'm going to jump right into it, is that when we are asked from an economic standpoint, what keeps you up at night? There's a lot of answers to that. You know, you could talk about some of the geopolitical risks around the world. You could talk about China specifically as an example, or Russia and Ukraine, or the Middle East. But when you think about what we can actually affect and what keeps you up at night, there is one chart out of over 65 pages in the guide and over 200 charts that we would say this is the chart that keeps us up at night. And I got into the industry about the year 2003, so it's been a little bit over 20 years. And when I think about the debt levels that our country has, you can't look at a clock and the number going higher, because that really is not a good data point. What you have to look at is what is the debt level of our country relative to the size of the economy. I mean, think about this on a household level. If you make $1 million a year and you have $1 million mortgage, it's probably not that big of a deal. But if you make $50,000 a year and you have $1 million mortgage, there's something a little lopsided there. So you can't just look at one piece of the equation, which is the mortgage. You have to look at the amount of debt relative to the size of the economy. And that's what you're looking at here. So in those 20 plus years that I've been in the business, look what the debt to GDP has done. It has absolutely exploded to the upside. But the really scary thing is when you look to the right of the dotted line and the Congressional Budget Office is saying, you know what, we've got a 10-year runway, whether or not you continue the Trump tax cuts or not, which is the red dotted line, or if you let them sunset at the end of this year, in 10 years from now, we've got a problem. And the problem, that's fine. The challenge here is that it's like a snowball. It's exponential. It gets worse and worse and builds on itself. And so at the end of the day, if this is the biggest problem, it's a very simple arithmetic equation. You either have to raise your revenues or you have to decrease your spending. Or the third scenario, which I'm going to say is the best, is you do both. You decrease your spending, you increase your revenue at the same time, and hopefully you could bring that deficit and debt to GDP down. Now, I'll get back to how you do that, but just let's look at the equation here for a quick second. This is the 2025 federal budget posted by the Congressional Budget Office. They do this every year. If you look at the right side of the equation, which is revenues, there's a shortfall of about $1.8 trillion this year that's expected. That's the deficit. Now, if you want to raise money on this side of the equation, you have to raise taxes somehow. And I use the word tax as anomalous with tariff because at the end of the day, whether it's a tariff or a tax, the government is going to make more money. Is it going to be paid by the U.S. consumer or by companies selling to the U.S.? Probably more of it is going to be paid by the U.S. consumer. But at the end of the day, I'm just going to use the word tax, whether or not you believe that the companies are going to take it, the countries are going to take it. At the end of the day, prices may or may not go up by something like, well, all goods will go up by 10%, maybe not prices. But we import about $3.3 trillion of goods every year into this country. So without getting political, I'm just going to do quick math. 10% of 3.3 trillion is about $300 billion in increased revenue to the United States government. That is one solution to the right side of the equation. I'm not saying this is good, bad, or indifferent, or if you like how it's being done or not how it's being done. I'm just saying if you put 10% tariffs, whether it comes out of our pockets or some other country's pockets, it's going to be paid. And it's going to be about a $300 billion change in revenue. That is a one step in the right direction. Then you look at the left-hand side of the equation and you say, okay, well, where can we cut? Now, I'll tell you where most people don't want to cut is in the three areas right in the middle: Medicare, Medicaid, and Social Security. Nobody wants to cut that because if the people that cut that, those are the same people that are going to be fired at the next election. So we have to be very careful, we meaning politicians, to self-preservation, to maybe look outside at some other areas. So let's look at some of these other line items. The bottom one is net interest, 952. This is the amount of money that the United States government pays on all of the treasuries we've ever existed that are currently out in the marketplace. It's about $1 trillion in debt service, which is massive. So I'm going to come back to that in a second. And now I'm going to go a little bit above Medicaid and look at other mandatory. Frankly, I don't know what this is, but by the word mandatory, I'm going to say, okay, we can't make a cut there. So then let's look at defense spending and non-defense discretionary. Now, whether or not, again, you believe in what Doge is trying to do or Elon or et cetera, there is an attempt to cut expenses. The number that was thrown out was 200 billion. It's probably not that much, but let's be conservative and say from the discretionary spending in the government, let's say they cut 50 to $100 billion in annualized spending. Let's go on the conservative side and say 50. So that's the orange at the top. So you got 50 billion potentially cut there. Then you look at the second piece of the pie and you say, okay, what about defense spending? Well, a couple of years ago, you'd look at that and say, well, I don't think we should touch that. There's a lot of wars going around in the world. It's very important that we have a good, high quality Navy. But you can't forget, defense spending is not just building planes. There's a lot of money and subsidies that are being sent around the world to protect other parts of the world. The U.S. government does a very good job of helping protect different European countries, different Middle Eastern countries, different Latin American countries. And oh, by the way, the Ukraine-Russia war has now cost well over $100 billion to date in U.S. spending. So with the potential conclusion, I don't know if that's the right word, but let's say the Ukraine-Russia war is not as big of a spend going forward as it has been in the past. Maybe you can get some money back there. Then you think about what's going on in Europe right now. Germany, as an example, about a month and a half ago, announced a fiscal spend of about 500 billion euros in defense and infrastructure spending. So what we're trying to do is push some of these other countries around the world to start to pay for their own defense. So what's going to happen is our defense spending on what we think it is, like building planes and aircraft carriers and building an army and a navy, we could keep that spending level or even move higher. At the same time, we could potentially cut this line item from decreasing some of that international defense spending. So my point is, let's say you get 50 billion from the orange, 50 billion from the purple, and then you go down to the bottom line item, which is net interest. As I said earlier, you take all the treasuries out there, it's all the coupons that the treasury pays out. This year is almost $1 trillion. If Scott Bessent is successful in his goal as the Treasury Secretary to get interest rates down over the next year, the way the Treasury Department works is whenever one of these bonds comes due, they issue another one for an equal dollar amount. So let's say Bessent is successful and they get the 10-year treasury from 4.3 or 4 down to 3.5 a year from now. So in that environment, that's about a 25% reduction in the coupon payment of the United States Treasury. So the point I'm getting at is now all of the new bonds, as the old bonds are coming due, and the Treasury Department issues new bonds at a 25% less of an interest rate, in 2 to 3 years, they could roll over a lot of that debt to a lower interest rate environment. And you could easily see the net interest go from 952 billion down to something like 850 or 800 billion simply by lowering interest rates. So what I just did there, and I know some of this for some of you is like, well, that's really simple math. I get it. And some of you may not think about this as much as we do. But when you look at that equation, if you were to decrease spending on the left side by 200 billion, increase revenue on the right side by 300 billion, that's a total difference, and that's a relatively conservative comment, of about $500 billion. Now, you might think, well, that's not going to solve a $1.8 trillion problem. But what it does, and this is one of the most important points I want to make today, is it brings down the deficit to something that becomes manageable. What do I mean by that? If you go from 1.8 trillion deficit to a $1.3 trillion deficit, what happens is, and this is important, the way the deficit is calculated, you take that number, 1.3 trillion, and you divide it by the size of your economy, and you get what you hear on CNBC when they say, we are running a 6% deficit this year. It's just that math of how much we're going to borrow relative to the size of our economy. And here is the point. We are going to have about a 6.2% deficit this year. At least that's the expectation. If you get that number from 1.8 to 1.3 and back into the math, it's about a 3.8 to 4%. Let's just use 4%, a 4% deficit. Now, what does that mean? That means this year we're going to have to borrow 4% more money than we did last year. If we can grow our economy faster than 4%, what happens is, going back to where we started, is the chart that matters most, the debt to GDP. If you grow an economy at 5% and you have a deficit of 4%, this number right here, this chart starts to go down. So it doesn't solve the problem, but it stops the bleeding. It puts stitches on a wound that is really bad right now. So I wanted to walk through that just to remind people that whether you love, hate them, indifferent about what's going on in Washington or elsewhere, at least there's an attempt, whatever political party is in place, to try to arrest the bleeding on the debt side. And so my silver lining here is that I wanted to walk through that and say, why are they doing what they're doing? There's an attempt to start to cut the bleeding, and that's potentially how we could get there. So Dan, I'm going to pause there and see if you have any questions, or if you want to turn your camera on or ask any questions, let me know.
Yeah, thanks, Bill. I will do that. Yeah, so I was really intrigued by that slide myself. I wanted it looked like it would be, if we were to have that math add up as you stated, that we would be for the first time since 2004 actually come out and have a sort of a profitable balance sheet, if you will, as a country. Is that right? Do I have that right? That would be the first time since 2004.
So that's a great question. And so to be profitable, you'd have to go from running that 4% deficit all the way down to actually running a surplus,
Right.
which in this environment, I don't want to say it would be impossible, but that's not the goal. The goal would be to get to a borrowing level that is a slower growth rate than the growth of our economy. So, like, put that in a household. Going back to the example I gave earlier, if I make $100,000 a year and I have a mortgage that's $500, I'm just making this up. Next year I make $110,000 a year. So I had a 10% increase in my income, but my mortgage payment went up by 8%. So it went from $50 to $54. So as long as the growth rate of my income or my economy, my personal economy, is growing faster than the debt, then that flat lines or even pushes that line down. What you're saying, which would be incredible, it's not going to happen, unfortunately, is if the debt basically would go to a surplus, and all of a sudden that mortgage we have a renter or something, and they're paying me more money than the mortgage is. And so, no, I don't think that's something that we're going to see in the near future, but it would be very nice if we could. But no, it's just the slowing down of the bleeding.
Got it. Got it. And do you think, and from your team's perspective, do you feel that that is attainable like in this year, next year? What's sort of the goal around all of this? And like how quickly can we, to use your words, stop the bleeding so that you do get a GDP that's growing faster than the deficit?
So we think it's potential in the next year or two that GDP is growing faster than the deficit. To get to a surplus, which is what you were saying earlier, you would have to make some serious cuts
Right.
that would involve a lot of people over the age of 65 that would not like it. And I will say this. When they created Social Security, I believe the year was 1935. The reason why they chose the retirement age of I think at that point it was 62 or 65, whatever the original retirement age was because that was the life expectancy at the time of an American. So they knew that just by the math equation, 50% of the people were going to be able to pull money and 50% of the people weren't. So there was never going to be an issue. But now you have life expectancy of early 80s in this country. So what do you do with all those people that are living a lot longer? So yeah, the problem is the way to solve that problem is you increase the retirement age on Medicare, Medicaid, Social Security, and that could quickly get you into surplus. But I don't think we're at the point where that's going to happen anytime soon.
Yeah, that's a great point. And I did want to touch on, and I think you may be covering it later. I did want to touch on Social Security and Medicare and Medicaid because those are topics that we hear often. But I want to get to one here that Sean just threw in. I've heard that there are less appetite for U.S. bonds. So if interest rates go down, is there enough demand to offset current costs? And then the second part of the question is, what if the rest of the world starts to trade in currency other than the US dollar? And to net, if the volumes go down, would that path to the balance be that much longer?
So it's a great question, and it comes up a lot. A couple things to think about. So looking at the amount of global trade that's in the dollar, it is still very significant, and the needle has not moved that much in the last few years. So as long as things like oil, commodities are priced in the dollar, there's always going to be a demand by all of these foreign countries to have US dollar reserves. And so that is something important to look at. I know there was a few countries, if you start to read, like China, and actually they call it the BRIC countries, which is Brazil, Russia, India, and China. It is India, but it's BRC, Brazil, Russia, China, trying to start to trade away from the dollar in terms of oil purchases. There's still the mass majority of global trade is done through the dollar. And the reason why that's so important is if you're a country like France, as an example, you have to manage the risk of your country because, of course, the French population uses gasoline and oil and energy. And so you need those dollars to be able to take into account the risk if oil prices go up or down. So there's still a mass amount of demand for the dollar around the world. And then going back to the question at hand, and this is really important, which is why I'm taking a lot of time to answer this. The demand for treasuries has not necessarily gone down from I've seen people write things like, China stopped buying treasuries. Well, that's not exactly what happened. China stopped adding to their book of business years ago, but they still roll over treasuries. In other words, if one of their treasury holdings comes due, they go back and they buy a new one. Whereas 20 years ago, they'd be buying more and more every year. So they were adding to their book of business. They're just not adding to it. They're currently rolling it over. One of the biggest buyers of U.S. Treasuries is actually U.S. regional banks. And this is a whole nother conversation I don't want to get into right now because it would take too long. But if you remember 2.5 years ago when Silicon Valley Bank went under,
Right.
if you were to pull up the 10-year Treasury chart at that point in time, as soon as that happened, most of the regional banks said, whoa, I don't want to be that guy or the next guy behind them. So I'm going to stop buying these longer duration bonds like 10-year and 20-year treasuries. And I'm just going to stick with the really, really short stuff. And so you lost this big buyer of US treasuries. And so when you hear Scott Bessent, who is the Treasury Secretary today, talk about banking deregulation, this is his attempt to bring that buyer back into the treasury market. And so, yeah, we're hearing about a decrease in appetite for US treasuries, but if he is successful in what he's doing both domestically and abroad, you're actually going to see an increase in demand for US treasuries. Last thing about this, and we'll move on, Dan. I'll give you a quick example of what I mean by that. JP Morgan has a Chase has leverage ratios and we have to satisfy as a United States bank. We are one of the largest banks. I think we are the largest bank in the US. So I believe our capital ratio is around 18%, which is one of the highest. So one of the laws behind that, Basel III, is the law that basically says you have to keep those ratios at those levels. Well, one of the things that this current group of Bessent and the Treasury is trying to bring down those ratios. So if JP Morgan all of a sudden doesn't need to keep that much money in cash that we had to keep in cash yesterday, what are we going to do with that money? And most likely that money is going to go into the treasury market. And that's another new buyer that most likely is going to come into the treasury market in the next year. So these are definitely things that the Treasury Secretary understands and has to be addressed. And so I know that was a really long answer, but it was a great question.
Yeah, I agree. Really great question. Thank you for that. We've got a couple others, and I've got a few others that have been sent to me by our community ahead of time that couldn't make it and will be taking advantage of the replay. You know, some of it is around interest rates, which as I'm looking at my TV behind me, it looks like the Fed just announced that rates are staying unchanged for the period moving forward. So we can maybe get into that down the road. But Bill, why don't you get back into the content? Because I know you had a few more slides you wanted to go through.
Excellent. If you just let me share again, and that was a very appropriate and good timing on that question. So moving forward, just a couple of slides kind of thinking about the economy and where we are. So at the firm, our kind of house view is that there might be a minor recession this year. Now, the word recession is very interesting. For decades, people said a recession was defined by 2 quarters in a row of economic contraction, right? So the economy shrinks 2 quarters in a row. It's already been announced that Q1 of this year, the economy contracted by a little bit. But there's something that we think is very different about this potential recession than what everyone on the call is used to. Now, when we think about U.S. economy, we grow at about 2.1% per year. And by the way, this is probably a good point to make. Previous slide, I talked about 4 and 5% GDP. There's a difference between nominal and real. When you hear GDP quoted on TV and what you see here, it takes into account inflation. So if our economy grew at 5% last year and inflation was 3%, then the real GDP is 2%. And that's what you're looking at here. So you'd have to add back inflation to get to that number I was talking about before. But let me get to the point. The 2 recessions that we've seen in the last 25 years were in 2008 and basically 2020 when COVID hit. Look at the mass reduction of economic output. The gray line is economic output. You can see in 2008 and then during COVID in 2021. Massive drop in economic output. And normally when you get these normal recessions, it's accompanied by a huge spike in unemployment rate. Because if you get a recession, companies are going to stop hiring. You've got all these people still looking for a job. And then what happens to the unemployment number? It skyrockets. So when you look at the gray line on this chart, this is the unemployment rate over time. You'll notice that these unemployment rates are lockstep with business cycles and announced recessions. 1992, 2003, 2009, and of course 2020. And you can see that, the gray line. And so one of the main things about what to think about with this recession coming up is why this might be different. We might have a cycle where you do get a recession by definition of 2 quarters in a row of contraction, where CNBC is going to love to say we're in a recession, but at the same time, you do not get a spike in the unemployment rate. So you might be asking yourself, well, why is that? Well, it just comes back to the math of you think about how unemployment is calculated, the number of people looking for a job that can't find a job. And so if you think about the labor market like a car, the faster the car goes, that's like the economy. So if the economy is growing 5, 6, 7%, the car is going really, really fast. And the car needs a lot of gasoline to pull into the engine to drive the car at that rate. So you think about gasoline like labor supply, and you think about labor demand as the engine. The engine is demanding a lot of labor. And so when you think about the labor market as gasoline, so demand was very, very high in 2022 when the economy was exploding. And now demand is coming down because the economy is slowing down. And like I mentioned, GDP might come to a halt for the next quarter or two. And so the demand for labor, the number of job openings may continue to fall. But look at the starting point of where we are. The number of job openings today, if you eliminate the COVID bump, there are still more job openings today than there's basically ever been in history with a 4.2% unemployment rate. So your starting point is that there's a lot of job openings. And even if those slow, there's still a lot of job openings out there. So that's on the demand side of labor. But on the flip side of that, and again, this is an apolitical comment I'm about to make. Now think about the supply side. Over the last 4 years, the number of workers that have been added to the U.S. economy has been very significant. So look at the bars on the far right, the last four bars, 21, 22, 23, and 24. Those are the amount of workers by millions that we've added to the U.S. labor force. But also look at the blue shaded area, which are foreign-born individuals. So in those 4 years, it's estimated that about 10 million new workers in the U.S. labor force were not born in the United States. So we know that there has been a significant attempt to slow down immigration, specifically illegal immigration in this country. I believe at the peak, there was something like, as reported, I don't know if the numbers are right or not, something like 500,000 people crossing over at every month. That was at its peak. And now I believe some of the most recent numbers are more like 12,000. So the point I'm making is that if you have a 6 to 12 month period where you have an economic contraction, i.e. the car is slowing down, well, maybe you don't need as much gasoline and you're slowing down the growth or the supply of our labor force. At the same time, you're slowing down the demand for labor. Then we could go into a cycle where you do see an economy slow down, but the unemployment rate does not spike. And so, Dan, I know I kind of bounced around. I just want to make sure, did that all make sense, or is there anything that you think I should cover on top of that?
No, I think that's crystal clear. I think that's crystal clear. I think we'll see if there's any questions at the end. Bill, why don't you continue along and finish with the content that you wanted to hit on, and then we'll see what additional questions the audience had.
Okay, great. Yeah, just let me share again. Sorry.
Oh, good.
Okay, so perfect. Let's just move a couple more. All right, so then the big question comes in inflation. So Dan mentioned about the Fed not lowering rates today. You know, the Fed was created, you have to go all the way back to Jekyll Island in 1913, and then there's a whole history there. But at the end of the day, the Federal Reserve has two jobs. Their job is to help the job market, i.e. look at the unemployment rate. And the second thing is to look at prices, i.e. inflation. And they have, the biggest tool they have is the Federal Reserve, the Fed funds rate, and they lower interest rates when they want to speed up the economy. And of course, they raise rates when they want to slow it down. They're okay with the labor market. So 50% of their job is like an A or an A plus. And then the challenge they have right now, of course, is inflation. And the reason why they don't want to lower rates yet, even though they know that rates are in restrictive territory, meaning they're higher than they should be in a normal economy, is because they're concerned about this chart. They're concerned about inflation as it's measured, CPI, and they're still looking at the measurement of inflation at the end of March of 2.4%. Now, a couple of things I want to hit on real quick. Their goal was to get inflation to 2%. How is inflation measured? Prices of goods and services this month, this year, versus this month last year. So that number all the way to the right is March 2025, 2024. Their concern, of course, is that if you start to bump up tariffs across the board and companies and countries pass those tariffs right back to the end consumer, that orange part of CPI, which is core goods, all of a sudden explodes again. Not explodes, that's a little aggressive, but shows up again like it did during COVID and the supply chain and all that stuff, we haven't seen core good inflation in a couple of years, and that roars back. And so, what the Federal Reserve doesn't want to do is lower rates prematurely. They want to wait to see the data before they start to lower rates. But I'm going to throw something on top of this that not a lot of people are talking about. What if, and again, I'm just trying to put a silver lining on here. What if in the next 6 to 12 months, you do get core good inflation? And by the way, our estimate is somewhere like 0.5 to 0.8% added on top of CPI. So if you're at 2.4, maybe that bumps it up to 3. So of course, the Federal Reserve does not want to lower interest rates at 3. But what if at the same time core good inflation is rearing its head? You get energy prices that are coming down. If you've looked at oil in the last 3 to 4 months, those prices have come down a lot. And so hypothetically speaking, what happens if you get somewhat of an offset from the green color, which is energy that are pulling down prices? At the same time, you get a little inflation for 6 to 12 months on the core goods side. And maybe we do get a softer landing with inflation, which 2 to 3 months from now allows the Federal Reserve to say, you know what, oil prices are coming down. Look, you can see that. Oil prices are coming down very quickly, which oil prices are permanent, right? Well, I'm sorry, not permanent because they could change, but they've come down and they're there. With core goods, if the price bumps up one time, 13 months from now, there's no more inflation. Let me explain what I mean by that. If an iPhone in March was $1,000 and you add 10% to that, it's now an $1,100 phone. So when you calculate inflation based off of that, it's a 10% bump in prices. A year from now, when you get to April of 2026, the phone is still $1,100. But now you're comparing April 2026 to April 2025, and the inflation on that is zero because you're at 1,100 last year, 1,100 in 2026. And so there's no more inflation there. And so the point I'm trying to make, again, trying to put a little silver lining, or maybe even try to help you better understand how inflation works. 3, 4, 5 months from now, the Fed's looking at this and saying, wow, inflation's not showing up as much as we thought because energy prices are going to come down. You know what? Maybe we should start to normalize interest rates. And when I say normalize interest rates, I'm talking about getting down to the number that they think it should be at in a normal economy, which is 3%. So we're at about 4.25 on the Fed funds rate today. Going down to 3% would be 1.25% drop in interest rates, which would have a meaningful effect on many things. It would have an effect on mortgage rates. It would have an effect on the economy. It would have an effect on the stock market, and that would be a positive all around. And so that's kind of the connection between the economy, inflation, interest rates, and of course, how we invest money. So to kind of close it out here, moving to the stock market, in the current environment, most analysts on Wall Street coming into this year were pretty optimistic on earnings for the S&P 500. In fact, the growth rate for 2025 was expected to be about a 9% earnings growth rate. I think every month or every quarter, that number is probably going to get a little bit lower given all the uncertainty. I mean, I read an article the other day that said a lot of US companies have to order their inventory now for like the Christmas timeframe. And so if you're a US company and you don't understand the tariff pricing and there's so much uncertainty, you know, how much do you order? You probably should order a little less. And of course, that might hurt earnings a little bit. So 2025 earnings, I think, probably going to come in somewhere lower than 9%. But look at the next 2 years, 26 and 27. Analyst earnings estimates for the next 2 years are very positive. In fact, we haven't seen earnings growth rates on those levels. You'd have to go all the way back to 2021, and that was the post-COVID bump. So from an S&P earnings standpoint, they look pretty good over the next 2 years. And don't forget, there's been a lot of policy uncertainty in the last couple of months, but the next couple of steps are tax reform. U.S. tax reform would potentially lower corporate taxes in the U.S., which of course would make stocks look cheaper. It would hopefully potentially bring back some production back to the United States, which of course would potentially help the U.S. economy as well. And there's other things in the pipeline, like I already mentioned, deregulation of the banking system, which would push more money into the economy. And so although there's a lot of uncertainty now and kind of negative impacts to the economy, on the backside of this, there could be and there should be positive policy impacts. So even though we expect a good earnings situation over the next 3 years, we can't forget that volatility in the stock market is normal. Volatility is what you and I pay for long-term returns of the stock market. So just a quick reminder about the normalcy of volatility. Over the last 45 years, 75% of those years, the market is positive on New Year's Eve at the end of the year. But that's despite every single year the market slams on the brakes and you get this massive turbulence. We hadn't seen a huge drop in the market in 4 years. We have to go back to 2022. And now this year we saw a 19% drop in the market. The average intra-year drop in the stock market is about 14%. So we did just get a big hit. A lot of that came from uncertainty, and we might even have more volatility. So the reason why I bring this chart up, and I know Dan and Rich use this chart all the time, is just to remind people that volatility is normal, expect it. The last thing we should do at this point is try to let our emotions tie into how we invest money. And we know historically, and I won't walk through this chart, that the best time to buy stocks is actually when people feel the worst. Looking at consumer confidence over time, if you look at these different peaks and troughs in US consumer sentiment, and you look at the 1-year returns after these troughs, historically, it's a great time to buy stocks. In fact, if you look at the 1-year average of all of those troughs of the stock market after it bottoms out, the average S&P return is about 24%. On the flip side, after a peak, it's only about 4%. So it's a 20% differential of having the guts to buy into the market when times are really tough versus when it's easy, when times are very, very good. And the reason why that's important now, it's the second worst reading in the last 50 years of consumer confidence. So all this market needs is a little good news, and that historically has been a good indicator. And finally, what I mentioned about timing the market, which so many people try to do, and the reason why that's so hard is because of this data I'm about to share, and then I'll turn it back over to Dan. If you put $10,000 in the S&P 20 years ago and just didn't touch it, you basically went to sleep for 20 years or you ignored it, that $10,000 would have grown at about 10% per year, and you'd have $71,000 at the end of 20 years. If you simply missed the 10 best trading days out of that 20-year period, which there's over 4,000 trading days, if you simply missed the 10 best, your return basically gets cut in half to about 32,000. So if I'm a long-term investor, principal point number one is I need to be in the market on those great days, or I'm going to start to deteriorate my long-term returns. But the problem is if you let your emotions tie to how you invest, 7 of the 10 best days have occurred within 2 weeks of the 10 worst days. So what emotional investors tend to do is you get a really bad day in the market, a 1,000, 2,000 point drop, and your knee-jerk reaction is, I'm scared, I want out, and you get out of the market. And then within 2 weeks, there's a 70% chance you get one of those great days. And then you say, okay, I'm comfortable again after one of those great days. And then you get back into the market and think about what you just did. You sold after you lost a bunch of money, and then you bought back into the market after the market went up. And this is why market timing is so challenging. And what the goal of every financial advisor is to do, especially Dan and Rich, is to prepare for volatility, diversification, stocks and bonds, high quality stocks, alternatives, and cash. And that's what financial planning is all about. So Dan, I know we went a little long, but I'll pause right there and kind of see if you have any Q&A.
Yeah, absolutely, Bill. And thank you so much. You are right. I absolutely love those last couple of slides because it shows you that if you try and time the market, exactly what happens from a data perspective. And I liked your phrase there. I hadn't heard that one before, but volatility is the price that we pay for consistent positive returns in the market. And our chief client officer, Rich, likes to say, it's not about timing the market, it's about time in the market. So I think those slides are so powerful. It really crystallizes what long-term financial planning and proper asset allocation is all about. So I appreciate that. All right, so I'm just going to shift gears really quickly, and then we're going to take some questions. I do see a few have come in here. Bill mentioned and used the words turmoil volatility, and uncertainty was one I heard throughout the presentation. So what we do here at Tailored Wealth is we try to help you prepare for and weather all of those things because we know that markets and economies are uncertain. So what I'm going to share with you now is a brand new tool. I mentioned this at the beginning of the discussion. This is a brand new tool that we just put together, and it's called the Wealth Resilience Scorecard. And what the Wealth Resilience Scorecard is a brief quiz or an assessment that will take you about 2 minutes to complete. They're fairly specific questions, and they're meant to help you to evaluate how your current wealth plan is set up amidst turmoil and amidst uncertainty. And you can see here that it's going to cover everything from your investments to your tax strategy to your overall financial plan. So you can scan the QR code. It's a free assessment that we offer. Like I said, it should take about 2 minutes to complete. I'll also put the link to this in the chat right now. So I'll do that. I'll put the link in the chat right now so that everybody has that as well. And then we will get our way over to Q&A. So let me just put that in there so everybody has it. All right. So the link is in the chat, or you can scan the QR code here on your screen, and we'll go from there. All right. So Bill, let's unpack some of the questions here. I'm going to first off try and sort of summarize what I think I heard you say relative to inflation and interest rates, because I know a lot of folks are thinking about that. But I think what you're kind of saying, and I've got my TV on in my office here, so I'm just reading the headlines as Powell's at the podium. It sounds like it's a wait and see approach right now from the Treasury and from the Fed around interest rates, because it feels like they haven't really unpacked the impact of tariffs and of some of these policy changes. Maybe can you elaborate on that? And would you say that's sort of what your team is looking at and thinking about relative to inflation?
Sure, Dan. Great question. So the Fed has said for years now that they're data dependent. They don't want to make a guesstimate on where they think things are going, because that potentially, one, it could open up for them to make a mistake, right? But two, they've said from the beginning of time for the Fed, which is 1913, is that they are an apolitical entity, meaning they should never be persuaded or dissuaded by anyone in a political party. And so they don't want to ever risk. That's very important, is the independence of the Federal Reserve. They don't want to ever risk making a decision and then being wrong, because then they could be looked at as, well, you did it because Trump said you should do it. And so they are a data dependent organization or entity that they do not want to start making changes until they see the data in place. And the data will be once the prices from of course, the tariffs start to flow through into CPI. That's when they could have a better gauge on the environment, what they want to do with interest rates.
Very good. Very good. All right. So let's shift gears a little bit to stocks and the overall stock market. It's an interesting time because you hear companies like Ford coming out and saying, we actually can't even project our earnings at this point in time because we don't know the impact of some of these tariffs are going to have. Now, you share some of those slides around sort of like a potential buying opportunity that we're in, or historically where we sit compared to other sort of run-ups in the market. And, we're seeing a little bit of a stabilization in the last week or so. What is JP Morgan's overall outlook on the markets and on corporations right now? And then the second question, which came from our audience, is what sort of is your firm most focused on? Are you thinking value over growth? Tell us a little bit about how you're feeling about stocks in general and then sectors. Oh, let me get you unmuted there, Bill.
Sure. Obviously, a great question. So I think overall, our view, when you're an analyst and you're trying to price what a stock should be worth, one is, well, what do we expect the earnings to be? So as we all remember, earnings are bottom line. So if you don't know what your raw materials are going to cost, then there's so much uncertainty out there across all these analysts, across anyone. Here's why we've had so much turbulence. I think the reason the market has started to settle out, people are starting to recognize that although Trump is talking very tough about China right now, the runway is getting very short on some decisions that have to be made. And I think for all the uncertainty that has been presented by this administration, the market is starting to say, you know what, something has to be done in the next week or two, or else we're going to start to open up other problems, which go back to what you said, Dan, about Ford and all these companies saying, I don't even know how to price my stuff. Well, the reality is a lot of companies are ordering 2 quarters ahead for their inventory. And so 2 quarters ahead now is going into the fourth quarter, and that's the biggest quarter of the year for the consumer. So I think that's why the market is anticipating that whether or not we fold, that's not the right word, but give in or compromise, or that we're very close to that. And so I think that's why the market's doing what they're doing, is that we believe that there is going to be some certainty from a pricing standpoint in the next couple of weeks. So I'll say that. As far as what to lean into, the whole market is still relatively expensive, but there's two things to think about. If they do lower taxes on U.S. corporations to 15%, when you lower taxes, it's increasing the bottom line earnings of companies. So what happens is valuations, or how we measure is the stock market expensive or cheap, overnight gets cheaper just because taxes go down and earnings go up. So that's one thing that can happen that will make the stock market even more attractive. But then more importantly, what are some areas to lean into? I would say the two sectors, number one would be financials, right? I talked earlier about the deregulation of the financial market. That's real and it's going to happen. It's going to allow banks and financials to be more profitable. So that's one area we're leaning into, or we like. And then the second, I'm going to say, would be something like industrials, right? So if this administration is successful in bringing some industrial production back to the United States, well, that's most likely going to benefit U.S. large cap industrial companies. So I will say, as a firm, we are more of a stock picking firm within each sector. We don't manage the money that we manage by saying we like financials, so we're going to buy more financial companies, but we are happy to comment on it, which is what I just did.
Yeah, very good. I think that's perfect. I think that's a great place to stop. I think, kind of the final line there was, we've had a lot of uncertainty, and, there's potential certainty ahead, but it may take some time. So, Bill, I want to thank you. Thanks so much for joining us. We always appreciate your team's insight. Thank you to JP Morgan as a partner, and I hope everyone on the call and those that are watching the replay as well get as much value out of your commentary and your team's research, and really how you boil it all down for the average investor, as certainly I have. So thanks for being a part of it.
Thank you.
All right, you bet. And then thanks to our audience. We appreciate you joining us today. This has been another quarterly market outlook update from your partners at Tailored Wealth. If you haven't already, make sure that you're subscribed to our newsletter for weekly updates on not only markets and taxes, but all things that impact your finances and your wealth strategy. And then I'll bring back up one more time our wealth resilience scorecard. So if you haven't grabbed that, you can do so via the QR code here. But that concludes our program. Thanks everybody for joining. Stay safe out there, and we appreciate your time today and hope you found it valuable. Cheers.